and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir, and I'm joined as always by Alan Higgins, and making a very welcome return to Need to Know, we've got Coutts US equity expert Howard Sparks. Morning, Howard.
Morning.
Good. So as always, we'll be looking at the three things investors need to know. Now, that might be for the week ahead, but we also look at longer term themes. But before we get to that, first of all, apologies if you were wondering what happened to Need to Know last week. Fortunately, we had a few technical issues with the recording, so we weren't able to bring you an episode last week. So sorry about that for those of you that are regular listeners, but hopefully we'll be not having any issues going forward. But Alan, welcome back. You were on holiday last week. Did you have a good holiday, first of all?
Yeah, very nice, thank you. But, always working on holiday, always reading, research, not really holiday.
Did you catch any fish? Or were you skiing?
No, it wasn't fishing. No, it was more tennis and reading. Read some great investment books actually, which we'll have to give some recommendations to. We haven't done that for a while. So no, it wasn't my usual pastimes of fishing and skiing.
Okay, but tennis is your other usual pastime. Okay,
true.
Right. Okay, before we get to the three things we need to know this week, and obviously the usual rules apply because we've got a guest. Howard's going to get two topics. Alan will get the third topic. A couple of things to catch up on whilst you were away. Now, you mentioned we're coming back to the subject. One of your favourite ones to rant about, Alan, inflation-linked bonds. We had a big discussion about inflation-linked bonds. If you want to listen to that podcast, it was from the 28th of November, and that was off the back of an FT article that was sort of in defence of index-linked bonds. And you've been reading up some more. I believe there was something in The Economist this week, wasn't there?
Yeah, actually, last week's Economist, it comes out on Friday. So, the FT had a go. So it's called In Defence of a Financial Instrument That Fails to Do Its Job, Inflation-Linked Bonds. And I think they should have stuck with it, fails to do its job. So the main issue I have is the fact that from an investor standpoint in the short run, especially in the short run, pension funds fine, 30-year, 40-year horizon. But short run, by the way, means a couple of years. Inflation-linked bonds can be a disastrous investment and not what people expect. I think we referred to that last time, didn't we, Sarah?
We did, yeah, because you gave an example of somebody that had a pension fund that was almost entirely in index-linked bonds, and it was down, was it last year? It was down something like 34% or something?
Exactly. That's the index. And that's because for inflation-linked bonds, yes, you get some inflation linking, but the interest rate movement is far more important in the short run. So this is someone's personal pension, but as opposed to institutional pensions that care a bit less, because we're getting a little bit technical here, because their liabilities fall rapidly as these interest rates move higher. But the other area of rant is then, okay, well, let's look at it from an issuer point of view. I mean, is it good news to be an issuer? Well, not really, because when times are tough, like last year on inflation, then if you have a large inflation-linked market, you're paying out huge amounts of interest.
Yeah.
And the UK has 25% of its bond market in inflation-linked, far too high, in my view. And interesting to see what this Economist article mentions is that Canada and Germany have stopped.
Okay.
They recognise this. And by the way, they have less than 10% inflation-linked. Sweden is considering stopping. And I just think our weighting is far too high and leaves us vulnerable to years like 2022. I mean, for its worth, this Economist article makes the point it's really useful to have a so-called break-even inflation rate calculated.
Okay.
It's kind of inflation. So what that is, you take a 10-year nominal bond, a normal bond, a 10-year inflation-linked bond, and then from that, you can subtract the kind of expected inflation rate. So I'm going to do that for you now as we speak. So in the UK, admittedly, this is using RPI. The current number is 3.5%. So what does that mean? So over the next 10 years, in 10 years' time, Sarah, if we're both alive, you own inflation-linked bond, I own a gilt. Okay, I will do better over those 10 years if inflation is less than 3.5.
Yeah.
You will do better if inflation is more than 3.5 over the whole 10 year. It's called the break even. So you can see it's quite useful as a kind of market indicator, and people even trade inflation. So I get that, but I stand by my point. 2 points. One, from an investor point of view, a lot of investors don't understand how much damage it can do in the short run because of the very high duration. Point two, from a government point of view, just when you want to help the economy, you're constrained by huge interest payments because the interest payments have an inflation element. So I just think the UK at 25% as an outlier is far too high.
Isn't it also I was going to say, just one last question. Isn't it also the case that index-linked bonds really only work when higher inflation is unexpected? If it's kind of baked in, are they less helpful, less useful?
Very good point. I mean, look, from an investor point of view, they offer some diversification. So it's interesting. So use this UK example. Yeah, exactly right. So inflation comes in at 3% a year for the next 10 years. No good. You should have just bought the 10-year standard gilt. You actually lost money relative. So exactly, only if unexpected inflation comes in. But the point I'm making is more subtle than that. Yes, there's that point, Sarah. But the fundamental point is that the movements in the overall bond market in the short run, and by the short run, I mean a couple of years, is far more important. And that's why the UK market was down over 35%. Over that 2022 period, because absolute disastrous move in bond yields. As opposed, the inflation protection didn't help you. So anyway, I've got to stop doing less of these rants, Sarah. You tempt me into it by saying, "Have you found anything interesting?" And I couldn't resist this Economist article.
I always love a rant. Okay, all right then. So Howard, I did say hello to you at the beginning, but welcome back to Need to Know.
Thanks.
Now you've got two themes.
Thanks for having me back.
Very welcome. What are your 2 points that you want to cover today?
Well, I would say for all the attention on the US, I would say Europe is the story this earnings season. So I'll get into all of that. And then secondly, again, if you think the US is concentrated, again, hello Europe. That's all I can say.
Okay, all right, then I'm looking forward to that. And then, Alan, what's your point, which I believe is kind of related to both of those?
Yes, it's related to that because we've had, I think it's worth saying, as it stands today, we're on the day of NVIDIA results. And I see one of the Goldman analysts says this is the biggest, forget inflation and rates anymore, this is the biggest macro mover. You know, forget Howard's world of picking stocks, it's the biggest macro mover. Anyway, so we don't know NVIDIA. But going back to the Magnificent Seven that make up 30% of the S&P 500, there or thereabouts, we've had 6 of the results. And again, you may recall that I was somewhat worried, given this concentration in the US that we're seeing, that active versus passive. I keep promising not to talk about active versus passive. I keep coming back to it.
I know, you can't. You're like a dog with a bone, Alan.
Yeah, exactly. I am. But anyway, good news. Howard actually sent me a great piece of research, which I'm just going to go into. Is actually. I don't need to be so discouraged. It's a great environment right now for active versus passive, despite this concentration. And to be fair, Howard did tell us this when he came on several months ago. He did. I should have believed him. But I'm going to have a bit of a debate with him because I think it's a very specific type of concentration that works. But anyway, that's what I'm going to talk about. Next week, I promise I'll find something different. Okay.
All right then, brilliant. Yeah, no inflation-linked bonds, no active versus passive next week. Those are the rules. Okay, anything else you can talk about? Actually, we are going to hopefully be having somebody coming on from Christie soon as well to talk about art, investing in art. So that's one to watch out for, or listen out for, I should say. Okay, Howard, let's come to you. You're a US equity expert. Why are we talking about Europe? What's going on here?
Well, I don't know. I just think that I also cover Europe. For the firm, so I do have a. It's not just a hobby, but I just think that it's really a struggle to find anything remarkable in the numbers, apart from the obviously the Magnificent Seven. But I think it's kind of been more of a normal earnings season in the US, if you can, if you can understand. And I've actually just been staggered by just how awful European earnings have been. So I thought that's probably more interesting, more timely to talk about that.
Okay, so what are we seeing in Europe then? Well, perhaps before we talk about that, let's just very quickly give us the big picture on the US. So what's the US looking like? We're just Okay, as I say, we're recording this on the day that Nvidia releases their results, which is, as Alan said, is going to be the big market mover. I mean, we saw that with Meta, didn't we, last week? That was a big announcement. But big picture on US earnings, it's kind of business as usual.
Yes, I mean, on the surface, we're on course for 5% earnings growth in Europe, which is pretty close to the long-term average. Let's not forget, this is hugely lopsided, right?
Yeah.
So you've got the Magnificent Seven, as we've talked about, all the big US tech firms. They're on course, this is obviously before NVIDIA, they're on course for about 56% earnings growth from this time last year, which is astonishing, really, given the size of those companies. And then the unmagnificents at 493, if I can call them that, are likely to see earnings fall by about 6% from last year. So it's one of those, it's a very lopsided environment. I have to say that this isn't going to persist, that we will see the 493 catch up and the 7 slow if current earnings estimates are to be believed.
Yeah.
And in terms of beats, if we look at, this is one metric that we look at and looked at for a long time, the proportion of companies that are beating estimates.
Yeah.
Now, what does that mean? Well, before earnings season, or every day, analysts are publishing estimates for sales, for earnings, and what this metric just does is on the day before or the week before earnings are released, did that earnings per share number beat the average of the analyst consensus? Right. So 78%. So that's pretty much in line with history. However, so anyway, that's the US picture.
Yeah.
Very lopsided, but really not too many surprises, really.
Yeah, but as expected, I mean, obviously, as I say, we're recording on the day of NVIDIA, and there'll be lots of attention on that. But okay, so then Europe, very different picture.
Yeah. When we started off, I mean, I'm taking a lot of data from Bank of America, so thanks to them. But when earnings season kind of kicked off, we were only seeing about 40% of European companies beat consensus. Now, normally it's a bit lower. We can talk about, normally the long-term average is about 55%. But
I want to come back to you and ask you about that in a minute. So keep that thought.
Okay. And it was running around about 40%. I think it's come up to about 48% of companies, but that would be the worst, certainly since the pandemic. And if you look at sales estimates, so European companies are reporting sales, that's even worse. That's only about 37% of companies are beating sales estimates, and that you have to go back to 2016 for a results season that week. So that's really been the story. Tech has on both sides of the Atlantic has been the star, but earnings estimates in Europe particularly are getting dragged down by a lot of energy and chemicals and industrials weightings, where conditions are clearly tough and actually getting worse.
Because actually, didn't you say, well, we were chatting about this before and we were actually preparing for this, you said that isn't the case that excluding oil, actually US earnings are up? Is that right? If you take out all the oil companies?
Yeah, that was me. Sorry to jump in, Howard. That was me. I saw that stat. I thought I was excluding oil, and it may have been to be oil and commodities. Earnings are a bit better, and because you start getting companies that I think it's fair to say, Howard, are more similar to some of the US companies coming through.
And that's presumably because the price of Brent is still is lower perhaps than it has been in previous years. That's essentially what's impacting the profits on those oil companies, I'm assuming.
Yes, that's right.
Yeah. Okay. I want to come back to this question of average beats. because it is very important. It's something we look at. So you were talking about, I think, if I'm right in thinking, the US, the average sort of percentage of companies that beat estimates every year is around about 70%. In Europe, it's 55%. Why the difference? Is that because are America setting, or in the US, are they setting lower expectations so they're more likely to beat? What's all that about?
I don't know. I mean, I think in the US, it's kind of always been about the number. It's always about beating EPS, and that's companies have got so many levers to pull that they can beat that number. I don't know whether Europe just don't really want to play that game so much. I don't know whether there's a kind of a European superior attitude to this kind of behaviour of, yes, we've just got to beat EPS and everything else is unimportant. I don't know. If anyone's got any ideas, let me know. But maybe that's the answer.
Yeah. Is it? Are we saying then perhaps in Europe it's less about sort of pleasing analysts and more about just perhaps reporting the numbers as they are?
Yeah, I suspect so.
Okay. All right then. So, I mean, that's the big picture is US is kind of business as usual. It's a bit lopsided, as one would expect, because of the Magnificent Seven. Europe, pretty poor. Okay, oil, obviously, sort of industrials and energy are struggling a bit. And we're getting below sort of historic averages as far as beats are concerned. But that brings us on to our next point, which is obviously, we talked a lot about the Magnificent Seven in the US, and we've talked, concerns about concentration in US markets. But how is that playing out in Europe? Because we're getting the same thing in Europe, aren't we? But it's even more concentrated than it is in the US.
Yeah, well, if we look at the returns of US markets, so S&P's up about 4% or so. About 60% of that number has, you can tie back to the Magnificent Seven or Magnificent Five, or so it's those big companies are driving that. If you look over in Europe, about 80% of the market's gains have just come from just 4 stocks in Europe. So that's Novo Nordisk, ASML, the Dutch semiconductor manufacturer, SAP, and LVMH. So it's actually arguably a more concentrated market, even though you can't quite see that from the index weights.
Yeah. Okay. And so, but there are some other sectors that are doing quite well, aren't they? Maybe they're not up at the level of Europe's Fantastic Four. Alan, you wanted to jump in with something.
Yeah, I think you're quite right, Sarah, because I'm taking a slightly longer term perspective, so less kind of this year's earnings, but I'm just intrigued. Over 3 years, I mean, Howard and team have done really well on luxury. So just to put this in context, this is a bit bigger picture. Europe, which includes the UK, has returned basically 30% over the last 3 years. Not bad. Okay. LVMH, 60%. Okay. Hermes, okay, it was a small stock now, and hard to get. We've talked about Hermes a lot, and we say 132%.
We have.
But then a bit surprising, European banks, which includes the UK banks, 60%. So European banks have performed the same, Howard, including dare I say, the underperforming UK banks, as LVMH. Nothing matches Hermes, of course. Sarah and I have a soft spot for Hermes. But so, yeah, and that's quite different from the US, isn't it? Where US banks, probably outside of JP Morgan, are struggling, right?
Yeah, that's right. Yeah, I think it's a difficult one to put your finger on. I think the market's clearly very different, and I think that the pressures on European banks are different from the pressures in the US. So yeah, I don't know. I'm quite surprised by that, by just how well European banks have done, because I'm certainly kind of under the impression that European banks just always screen as very cheap, very attractive, but then just it's almost 2 steps forward, 2 steps back or whatever the
Yeah.
right expression is. But
Well,
they always seem to like recover, and then Credit Suisse will happen, or there'll be another something which will happen, and they'll all sell off again.
good point. I mean, Credit Suisse was included in this index. Just it happens to be 3 years, okay, and so JP Morgan over these 3 years 30%, which is reasonable. But this is it. Intesa, which is a very good Italian bank, 74%. And my understanding is, as you say, it's very idiosyncratic, is that unlike US and UK banks, I mean, UK banks, including these index, European banks have really benefited from higher interest rates. We put it simply, they haven't had to pay it for deposits. And that's fairly unique. How long that's going to last, we don't know. But, you know, and we should say, Howard, isn't it? This is after years and years of underperformance. These have been really bad stocks for years, right? Continental European banks, UK banks.
Yeah. So going back to the sort of the big picture again. So US is business as usual, slightly lopsided because of the Magnificent Seven. Europe is really sort of very disappointing this season. What's behind that? It's not just a lack of an equivalent Magnificent Seven. What else is behind those poor earnings, do we think?
I think there's clearly an absence of demand in Europe. I mean, I don't know. It's difficult to kind of necessarily look right across and find kind of common themes, but I don't know. I'm not the macroeconomist. I just like look at companies. Alan, what do you think?
Well, I just think the European index is much more commodity and cyclical and value orientated than the United States. But going back to Howard's point, Europe has some amazing companies. We just mentioned some, but have we mentioned the most amazing European company of all? At least in terms of performance. Because I was fiddling with, you can tell this is live and unscripted. I was fiddling with Bloomberg while Howard was talking and pulling up. Have you mentioned Novo yet, Howard?
Yes.
You did. I was fiddling with Bloomberg as you were talking. So, I mean, there are some remarkable companies in Europe, and also, despite the general value cyclical exposure, but European banks shows that value can work. There is more than one way of working. Yeah.
Okay. All right then. So that's very interesting, and we're seeing, as you say, that concentration in Europe with Novo Nordisk, ASML, SAP, and LVMH. So coming on then, Alan, to your point, which is yet again you're going to talk about passive versus active. This and index-linked bonds are your two favourite subjects at the moment, and you've long been banging the drum for a return to active management, and there's been some debate, and I think we're going to have a little bit of a to and fro between you and Howard now about whether concentration in markets is good or bad for active managers. But sort of thoughts on that then, because you've been reading some research from Bank of America on this subject, haven't you?
Yeah, so we don't just read Bank of America research, do we, Howard? But it just so happens Savita, who's the very good US equity, I think we've mentioned her before, the very good US equity research and quant strategist at Bank of America Merrill Lynch had pointed out, I think Howard knew this anyway, but so bottom line is, for the last 6 months or so, we've said, it's time for active to come back, and I've talked about the so-called equal weighted S&P 500, and I actually just looked since end October, both the equal weighted S&P 500 and the standard S&P 500 have returned about 20%, surprisingly high, depending on the exact date that you pull up towards the end of October, because it was volatile then.
Just to interrupt you, Alan, just then for those listening that don't understand the difference, just very simply, very quickly explain the difference between the equal weighted S&P and the normal S&P.
So the normal S&P is that each company has its correct market weighting. And we kind of referred to that 2 weeks ago, didn't we, with James from Dealing. So when someone puts money into an S&P 500 index fund, they buy Apple and Microsoft at a circa 7% weight, at exactly the right weight, but they also buy General Motors and JP Morgan at exactly the right weight. It's a completely neutral allocation, but you take a full 7% weight to the correct market weight of these companies. In contrast, the equal weight basically says, forget that, take the 500 stocks, we'll own them all in the same size. So your Apple exposure and your Microsoft exposure falls from circa 7 to 0.2%. Everything has 0.2%. So what it means is that if the Magnificent Seven are soaring ahead, you don't have the full weighting. You have tiny 0.2% weights in each one. So, and it started to underperform this year after doing well. But what this research shows is that actually the very specific type of Magnificent Seven returns we're seeing this year, which is basically Microsoft, great. Nvidia, great. We'll see how it goes today. And Facebook or Meta, great. Very, very strong corporate performance and stock market returns, is very good for active management because Apple and Tesla are really underperforming. And for whatever reason, almost no one out there in active management is overweight Apple or Tesla, except for one very famous investor who's overweight Apple, which is Warren Buffett. Howard, I think it's fair to say he's virtually the only one we can find, right? In terms of active managers that are overweight Apple.
I think lots of active managers, and most active managers will own some. But yeah, you're right. He owns 6% of the company, I believe.
Yeah, correct.
That's incredible.
Yeah. So a huge way. And it's done well, but generally, when I think it's look, I'm not a stock analyst. It's probably people might think it's an easy company to analyze. It's not. It's a hard company to analyze. I agree. Whereas people seem to be much more comfortable. I mean, Howard, maybe yourself included, in the Microsofts and Metas of this world.
Yeah, I was just looking at the analysts and how they're positioned and whether we're seeing a similar sort of thing. And so, hate to bombard you with numbers. Here we go. There were 57 analysts I can find on Bloomberg that cover Apple. Only 33 of them are buy rated. So only about half of them have a buy rating. For Meta, that number is, well, there's more analysts. So there's 75 analysts and 64 are buy rated. So the vast majority are buy rated. But Nvidia, get this, right? So 66 analysts and 60 are buyers. So, I think it does, that kind of tends to support this idea that there's certainly much more negative sentiment around Apple, particularly if you look at the sell side analysts and their ratings. But, I don't know, that's not very scientific.
So are we saying then that concentration in the market is not a bad thing for active management as long as you've got a couple of those real star performers actually not doing as well as the other star performers in relative terms? Is that what we're saying? You need to have a couple that are not looking quite so good, and then you can make your active decisions within those Magnificent Seven in this case, but there's a couple that you can leave out or you can hold, but maybe you're underweight, you're not overweight. Is that what we're saying?
I think so. So, if you've got big market heavyweights that are not performing well and they're in a steady downward trajectory, can't clearly say this for the likes of Apple, but that's a gift for active managers.
I agree with that.
If you think about, part of active management is what you buy, but also it's what you don't buy. So
I agree with that. The challenge would be, though, Howard, as we know, over the last, more recently Apple's started to underperform, but over the last 5-7 years, Warren Buffett's been right. and the rest of the industry's been wrong. Apple's been a great stock to have. And by the way, the likes of, Bailey Gifford has been right on Tesla, right? Until recently. So these stocks that were relatively unpopular within active management. And I'm not talking about yourself, Howard, but this is that we should say, Sarah, shouldn't we? Compliance. This has nothing to do with stocks that Coutts might have in portfolios
absolutely.
or may advise on. We're just talking generally. That, Apple and Tesla that people haven't owned has been a big contributor to underperformance because it's been so hard to get right. It's just, it has changed. So my fear was, well, it's still a concentrated market, but it seems to be the right concentrated market because exactly as Howard said, because Apple is underperforming. But I would counter, should Microsoft and Nvidia and Meta start really underperforming, I do wonder about active management again. These seem to be very, very popular longs, justifiably so. They've also been fantastic stocks, but so I'm still biased towards the equal weight as opposed to Howard's very difficult job of trying to pick which of the Magnificent Seven are going to be the great stocks.
Mm. Do we have any data? I'm putting you both on the spot here. Do we have any data for how successful active management is or is not in Europe? Bearing in mind that we've got super concentration in Europe.
I do. It's the same. Remarkably, it's the same. It's circa over 5 years, 80 to 90%. And Sarah, set me some homework. Next week, I'll give the exact number. Yeah. 80 to 90% of managers underperform in Europe over the last 5 years. It's also really tough and disappointing. Again, we expect that to change. We're going with more diverse performance going forward. But yeah, the numbers in Europe are also a real struggle.
Okay, all right then. So in summary, then we're saying that again, this concentration in markets isn't necessarily a bad thing for active management. It depends a little bit about what's happening within that sort of concentration at the top of the market, especially if you've got maybe a couple that are relatively speaking underperforming. It actually might be quite a good thing for active management because then you can make those decisions then to hold less of those underperformers and still have your exposure to those big mega caps. Thank you very much. A reminder, as Alan has already mentioned, that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording and are subject to change. Thank you very much, Alan and Howard. Thank you for listening and for all your comments, suggestions and feedback. As always, they're always very, very welcome. If you've got anything you'd like us to look at in more detail on an upcoming episode, let us know. Was anything you think Alan should be ranting about other than index-linked bonds? Let us know. We'll be back with more Need to Know next week. Until then, bye for now.